Hello traders, and nice to see you all. My name is Ali Akbar, and today in this video I'm going to address a common concern raised by many of my viewers who have experienced challenges with using price action alone, often resulting in break-even trades despite putting in considerable time and effort. This situation brings back my own memories when I was a novice trader, relying solely on price action and finding myself in a similar break-even position. I eventually decided to shift my approach and focus exclusively on utilizing various period moving averages in my trading setup. After experimenting with different options, I discovered that the 50 period exponential moving average is proven to be remarkably effective. However, even with this change, I still found myself struggling to break through to consistent profitability. It was only when I decided to combine trending market that the price is making higher swing high and the pullback is making higher swing low for uptrend, and conversely lower swing low and lower swing high for downtrend with EMA50, that I experienced a significant turnaround. I have a couple of videos on this issue, but this one is going to be exceptionally interesting to you. This shift transformed me from a break-even trader to someone who consistently sees profit in his trading account. The strategy I am about to share involves 5 straightforward yet highly accurate stages that needs to be followed closely. Now let's delve into the detail of this powerful strategy, so stay tuned. In this slide, I'm excited to share with you the 5 stages of this strategy. Let's begin with stage number 1. We dive into realm of price action. We start with a push upward, followed by a pullback, which create a resistance level right here. Then we witness a second push upward, breaking the previous resistance at this point and continuing its upward trajectory until the buyers begin to lose momentum and the sellers take over, aiming to push the price lower. Moving on, the second stage of this strategy, we carefully observe the second pullback, a result of sellers gaining control and giving the price back toward the previous resistance level. Now turn into support. When it comes to drawing resistance, I'll show you my approach. It's not just about rigid line, but more about identifying a zone or area where the previous resistance was. And I illustrate this one like this. This area is also considered as buying pressure zone, and we will see clearly later on the price is bouncing off this zone heading upward. Stage number 3, this strategy involves combining the 50 period moving average with price action. This dynamic fusion is designed to steer us toward consistent profitability, steering clear of the break-even zone. Stage number 4, we explore the entry trigger and consider the relevant rules that we have to take into account. And finally, the last stage is stage number 5. We delve into employing essential risk management practices, covering both stop loss and profit targets in this strategy. Each of these stages play a crucial role in this trading strategy, and I'll be discussing them in detail on the real price chart in the upcoming slide. So please stay tuned. This is CL stock on D1 time frame. Now let me show you why this buying pressure zone is so significant. When prices are ascending and experience an upswing, sellers gain momentum and decide to enter the market. When price reaches at this location, buyers lose some momentum, resulting in a pullback. However, as price rise once more, surpassing the previous resistance now turning to support, buyers regain control. This unexpected shift catches sellers off guard. The buyers determined to maintain control are now determined to drive prices even higher than the previous peak. They are determined to hold their position regardless of how many sellers join the market. Next, we look for a higher swing low within this trending market. This low indicates a temporary drop toward the area that was once a resistance but has now turned into support. Conversely, traders who fear a potential decline may exit their position when they witness prices climbing. Having already exited their short position, they are obliged to buy or re-enter the trade. This influx of buying, coupled with existing buyers, intensify the upward pressure, propelling price to a new high. The second aspect of this strategy involves establishing our resistance area. We do not have a specific rigid rules. It is more like of a zone rather than being a line, where the previous level of resistance was, and that was just broken. I draw my resistance level like this. We do this because this is where we expect more buyers to enter the market. It is also a point where those who exit their position here may become quite anxious as the price pushes higher. If they didn't have a stop loss in place, this is their opportunity to exit, likely near breakeven. So if they initially had a sell trade, they now have to buy in order to close their position. This buying activity automatically pushes price higher. When combined with the influx of more buyers entering the market, we tend to observe movement that propel prices to new high. Next, we include the 50-period exponential moving average. So please stay tuned. Stage number 3, combining the EMA50 with price action. In this segment, I'm introducing the 50-period exponential moving average as a crucial element in analyzing crude oil stock on a D1 time frame chart. This moving average acts as a support level and is integrated with price action for a more comprehensive approach to trading. As I have mentioned earlier, I encounter challenges when I solely rely on various moving averages in my trading journey, struggling to transition from break-even trades to consistent profitability. Now let's delve into how you can elevate your trading skill by combining the 50-period exponential moving average with price action. When the price undergo an upward surge followed by a pullback, and subsequently the second push-up break through prior resistant level to ascend further, it eventually retraces to the former resistance, which now serves as a support area, what I term the buy pressure zone. Crucially, this pullback should also intersect with the 50-period exponential moving averages at this location. It is imperative to understand the specific criteria I employ to recognize this 50-period moving average as a support level. Firstly, as long as the candlestick remain above the 50-period moving average and maintain contact with the EMA50, I consider it as a valid support. Secondly, even if a candle closes below the 50-period moving average, but its upper shadows touches the moving average, I still regard it as a support level. However, I stop consider the moving average as a support level if a candle closes below the EMA50 without making any contact with the moving average whatsoever. At this point, I no longer view the EMA50 as a support level. Moving on, I will elucidate the specific entry trigger and a comprehensive set of rules you need to bear in mind when entering a trade. This will equip you with a clear strategy for executing profitable trades. So stay tuned. Stage number 4, entry trigger. Let's take a look at this price chart. The entry essentially boils down to identifying buying pressure, which can manifest in various forms. This might be in the form of divergence, volume surge, break from a resistant level, support and resistance analysis, trend line breaks, moving averages crossover, or in the shape of candlestick pattern, like a bullish engulfing, hammer, morning star, tweezer bottom, or bullish harami candlestick pattern, or could also be a candle with a long lower shadow and a significant green body. Regardless of the pattern you use, it is crucial to have specific rules in place for these candles, which is crucial for precise entry. In my approach, I have a clear-cut criteria for what I consider as buying pressure. For instance, a bullish harami pattern is observed right here in this example. When the subsequent candle moves higher than the bullish candle in bullish harami pattern, that is the convincing trigger for me to execute the buy order for that particular trade. In my next slide, I am going to show you how you put your stop loss and profit target in order to protect your asset from sudden market reversal. Stage number 5, stop loss and profit target. In this crude oil chart on a D1 time frame, I have established consistent rules for determining stop loss and profit target levels. Typically, I position this stop loss just 2 ATR below the close price of the third bullish candle in harami pattern, like this, which serves as our entry point. As for the profit target, I aim to set it at 380R above the close price of that candle, like this. Alternatively, you can also consider placing your profit target at the next level of resistance. This approach provides a favorable 1.5 reward to risk ratio. On the top left of the screen, you will find the information pertaining to the bullish candle. Next, we will take a look at a bearish example of this strategy, so please stay tuned. Welcome viewers to the bearish version of our strategy, combining the 50 period exponential moving average with price action. This is USD franc currency pair on a H1 time frame. To initiate, we require a clear downtrend in the price, serving as our first condition for this strategy. As you see, the price is trending nicely downward and making lower swing low, and the pullback is making lower swing high, which is the characteristics of a downtrend. Next, we observe the price initially descending downward, followed by a pullback, forming a support level right here. Hereafter, sellers take charge, driving the price below the prior support, now turned into resistance, sustaining the downward momentum. Buyers substantially or subsequently step in, pushing the price toward the former support, now resistant, making a significant movement. Here the price rests below the 50 period exponential moving average and making contact with EMA50, which is the rule for this strategy to act as resistance level. Additionally, a bearish shooting star indicating a bearish reversal enhances the uptrend, with its upper shadow extending into the selling pressure zone, presenting a significant opportunity for sellers to drive the price lower. This shooting star serves as an excellent entry trigger and a compelling reason for traders to exit the trade. Consider exiting at the close price of this shooting star, placing a stop loss 180R above its high, and setting a profit target at 3 to 480R below its close. Detailed information about this candle is available in the top left corner of this slide. So this was the bearish version of this trading strategy. If you find this video valuable, please give it a thumbs up and subscribe for timely updates on future videos. That's all, folks. If you like this video, thumbs up and subscribe. Thanks for watching. Take care and see you next time.